Really do appreciate you joining us today here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Scott Kirshner. 419-794-3030 is the phone number. It's 419-794-3030. Always online, americasretirementheadquarters.com. Now, guys, you've often cautioned on the show to avoid taking distributions from an IRA or a similar retirement account before age 59 and a half, and the reason is a whopping 10% tax penalty. But are there any exceptions where withdrawals can be made without having to pay that 10%?
Yeah, this is one of those areas that you really have to work with somebody that can help you navigate, what's the best way and how are distributions from an IRA taxed. It's very confusing, but we'll give you a couple of really good tips here. There's a tax continuum on different time frames that people need to be paying attention to. I recently met with a gentleman who retired. Mm-hmm. He was blessed enough to retire at the age of 57.
Well,
yeah, so
good for him.
Excellent opportunity. But just like in your example that you're talking about him, if Bill decided to take his 401k and roll it over to a self-directed IRA, by doing so, he would be subject to a 10% early withdrawal penalty if he took money out of that 401k between the ages of 57 and 59 and a half. Yet in Bill's situation, in the 401k, it falls under the age 55. So he can technically take withdrawals from his 401k at the age 55. So, how to avoid some of those tax penalties in his situation was leave some money in the 401k that you think you're going to need to bridge the gap until you get to 59 and a half. And then that is a great way to avoid the IRA penalties. The other thing is a Roth IRA is a very misunderstood vehicle. Where a Roth IRA works is if, again, you follow the rules, keeping the account open for at least 5 years until age 59 and a half, you have some flexibility on how you can take money out of the account. But one of the nice things about a Roth IRA is you have the ability where you can take out contributions at any point.
Okay.
So, during the course of your lifetime, let's say you saved up $50,000 in a Roth IRA and it's worth $100,000. Well, you can take out the $50,000 of your contributions before you get to the profits if you're under the age 59 and a half and avoid that tax penalty too. There's another IRS rule that's out there. It's IRS Rule 72T, and what that does is that allows somebody under the age 59 and a half to use a amortization schedule that generally allows them, based upon their age, to take out roughly 4% a year. But, Scott, the other thing I would say is not only is this 10% penalty in figuring out distributions and figuring out how distributions are taxed from an IRA, is you have to think about the snowball taxation problem that this creates. Mm-hmm. Another good example is with the money that you pull out, for those of you who are under the age 65, if you're going to get health insurance through the Affordable Care Act, one of the things that they're going to do is they're going to look at your income sources. So not only could you be facing some of these penalties, you could also take money out that increases the cost of what your affordable health care is. I can think of two particular cases. One, a gentleman who just recently retired, him and his wife, at the age 62. Mm-hmm. And so what we had to do is bridge the gap to get him to age 65.
Right.
So when we developed their independent income system, it's our unique trademark process on how to create a retirement written income plan. What we did is we took a look at converting some of the money over before he retired to a Roth IRA.
Right.
That then gave him a bucket of money that he could pull from, and it wouldn't be counted against him when he applied for the affordable health care costs.
That's exactly right. A Roth IRA does not count as reportable income. Well, in a sense, what that's going to do is if anybody that is looking for health insurance, like you mentioned the guy's name Bill here that retired at 57, he may lose employer coverage, so he's got a gap in health care from 57 to 65, right? Well, if he retired and has, depending on what his income levels are, health insurance for someone 57 to 64 years old is quite expensive. I've dealt with a lot of people over the past couple of months and are in this very situation, and they're saying, well, do I want to even sign up for Medicare because of my employer coverage and this, that? And where I run into this a lot is where I'll have someone that is maybe turning 65 and their spouse is 62. So they've got 3 years of gap there, right? Taking Roth distributions lowers the reportable income, which in turn will increase your subsidy, your premium tax credit from the government, which will lower your monthly premium, okay? At the end of the day, that's what we want to do. We want to make sure that you're paying as little as possible, because not only is your premiums higher when you hit that 60 and older, but so are your out-of-pocket expenses. They're going to be far greater. You may be looking at an $8,700 deductible with I quoted a family from Michigan. They're paying $1,100 a month in health insurance. So they're looking at roughly $20,000 to $22,000 out of their pocket if they were to have a catastrophic health claim. Well, that's a lot of money for someone that's near retirement.
It can really add up. So if you're looking at it again, and you're looking at how are distributions from IRA taxed, not only avoiding this 10% penalty, but avoiding how to overpay for taxes. And what I would say is they asked that famous bank robber, "Why do you rob banks?" Willie Sutton. Remember what he said?
I don't know.
It's because that's where the money is
That's
at.
where the money's at.
And
exactly.
if you look at it, retirement accounts are either the biggest or second biggest assets that somebody owns. And so the government might have your retirement account in their crosshairs to be able to come after. And again, with the out of control spending that we've had on the government, that higher taxes or tax penalties and navigating this environment can be somewhat of a challenge. What I would say is we are as financial professionals. I'm not a CPA. We have a couple of great CPAs and accountants that we work with. So you always want to get good tax advice before making financial decisions. We'd love to introduce you to our CPA and or work with yours. The solution here is to create a tax roadmap. What I have found is that the overwhelming majority of Americans either use some type of software to do their taxes, or they go meet with a CPA or an accountant, and they record history, right? They record what happened in the past when they file their taxes, but they never take time to figure out a blueprint or a plan to go forward to navigate how should they best take distributions from their IRA to minimize the taxes. And that's where somebody like we come in and we step into the equation. So some other things to think about when you're on this topic is next would be Social Security taxes.
Sure.
Talk about a double whammy, right? A lot of people don't realize that up to 85% of your Social Security can be taxable in retirement time based upon where your levels of income are.
Sure.
Now, that's not an 85% tax. What that means is that 85% of that is reportable on your tax return once you reach a certain level of income, making that taxable at whatever tax bracket you're at. In addition to that, another double whammy that they can get you in taxes is the fact that if you are still working and you decide to draw your Social Security before your full retirement age, you can have a third or more of your Social Security become a tax problem for you too. So there's another big issue to worry about when you're looking at distributions and how to set up your retirement income plan. The other one that I think that falls into play when we're talking about the distributions from the IRA tax that people don't think about is the impact not only that it has, Scott, that you were talking about if you retire before 65, it's also the impact that you have after 65. So there's a Medicare premium that Americans have to pay.
Right.
One of the common questions I think people will ask me is they'll say, Nolan, we want to retire and we've got X balance left on our mortgage and we're just going to go ahead and pull a bunch of money out of our retirement account. Yep. We want to pay off our mortgage and be debt-free. Look, folks, I get it. Being debt-free is a great way to be, and I would encourage anybody at any age to be debt-free as much as possible and eliminate as much debt and stay out of debt, especially in today's environment. Debt-free is the way to be. But what you have to think about, Scott, is when you're taking distributions from an IRA, how does that impact Medicare?
Well, it impacts it. There's a great impact there because what will happen is the IRS will actually look back 2 years. So if you take a large distribution or if you retire and take a lump sum plop and you don't do the proper investing with that, your income could throw you in a situation where instead of paying the standard Medicare Part B premium of $170.10, you could be looking at anywhere from $208 to $547 a month.
Ouch.
Not only for Part B, but then you also have that wage and income earnings for Part D prescription plans too. So you could conceivably pay $620 a month just to be on Medicare. That's not including any other out-of-pocket expenses that you might incur. So it's very important to be aware of that. Now, you can file for appeals for that. I've had some clients that actually have had their income, and now that they're retired, they're saying, well, I'm not making $400,000 anymore. I'm retired and I'm not claiming that income. They go back 2 years. They say, well, here's what you want to do. You want to actually file an appeal, have Medicare and the IRS take a look at that, because what they may be able to do is say, okay, now that you're retired, your income is going to be lower, so they won't charge you that higher earning premium for Medicare. So it's very important, like you said, Nolan. You got to really pay attention. That's what we do here. We work with people, and honestly, that's how you and I even kind of got in business together, was, referring clients back and forth and helping them out to make sure they maximize their premium tax credits, keep their reportable income as low as possible, to keep them from paying them high premiums.
Yeah, in dealing in the industry that we're in financial services and insurance, one of the things that we have is we have a lot of training that we go through on elder abuse, right? But here's one for elder abuse that the government does that maybe you didn't know. So again, when we're talking about how are distributions from IRA taxed, at the age of 72, there's something called a required minimum distribution. You want to find out about the highest tax penalty that the government imposes on people? It's our seniors and retirees who fail to follow the distributions from IRAs at the Rule 72. What happens is you have a minimum amount that you have to pull out, and if you fail to do that, that's a 50% tax penalty. 50% tax penalty.
Wow.
Yeah, so again, another big issue that comes up. And, as we get older, we tend to slow down, and these are areas that you have to watch out for. So navigating these rules is something that here at America's Retirement Headquarters, we spent our entire lifetime working on and helping people navigate these waters. Again, working hand in hand with our CPA and or your CPA. And the solution here is, if you're wondering, am I in the best situation for taking distributions from my IRA from a tax perspective, the solution here is to have us create a tax roadmap for you. We'll take a tax roadmap. We'll use history to create a blueprint and a guideline moving forward to show you how to navigate some of these waters and give you some of these important dates to stay away from, to avoid some of these big penalties.
And unlike the tax software or the tax professional that you use, every April to see what you owe for the previous year, this isn't a looking in the rearview mirror sort of thing. This is looking forward for the next 20, 30 years, making sure you minimize the amount that you have to pay to Uncle Sam. There is a difference between tax mitigation and tax evasion. Tax evasion is, of course, illegal. That's not what we're talking about here. We're talking about, making sure you get to minimize the amount that you have to pay to Uncle Sam, and you get to keep more of it for yourself. To figure out how to get started, pick up the phone, give a call, 419-794-3030. That's 419-794-3030, or go online to Americasretirementheadquarters.com. This is America's Retirement Headquarters. He probably should have already been retired, but we're going to talk about why Colonel Sanders is glad, and why I'm also glad he decided against it, coming up next.